This is the game of chess. Each move is calculated based on clear outcomes. There's not much risk if you can see the best moves and their consequences well in advance. It sounds a lot like investing, right? What about poker? It is the game of probabilities, and risk is an integral part of the game. Just like trading, isn't it? But how accurate are these comparisons? If we define a game as a collection of observations, decisions and actions, and the strategies, investing and trading can also be considered as games. In this video, we'll deep dive to understand the parallels between these classic games and the world of investing and trading. We especially focus on what these games can teach us about the strategies and skills needed to be successful and profitable in the long run. So are you in the right game? Let's dive in and find out. We start with the basics. The chessboard is an 8x8 grid consisting of 64 squares. Each square is a unique coordinate that can be controlled, contested, or sacrificed in the game. But the board itself is just the canvas. The true story lies in the arrangement of the pieces on the board, which represents the state of the game. As the game evolves, the position of pieces on the board creates a snapshot of the current balance of power. It contains all the information available to both players. Therefore, chess is a game of fully observable information. We can represent the game environment abstractly by mapping every possible chess position onto a grid. This forms a vast plane encompassing all potential chess positions, an incredibly large space. In fact, it contains approximately 10 to the power of 44 possible positions. At any moment in the game, the arrangement of the pieces corresponds to a single point on this plane. Let us look at poker now. This is an environment where availability of information to the players is fundamentally different from chess. You obviously always know the cards you're holding. But what about the cards of your opponents? Very often, this information is not being fully revealed while you are actively playing in a poker hand. The best you can do is to assign a range of possible cards to your opponent based on the flow of the game. You analyze their actions, their bets, their raises, their folds, and use that information to narrow down the possibilities. This process of deduction and inference is the most crucial part of poker. If we go back to the information state plane, it is impossible for players to pinpoint the state of the game to a single coordinate at any point. Instead, depending on the player's belief about the opponent cards, they can narrow down the possibilities. In this visualization, we create a point on the plane based on how probable we think our opponent holds a certain combination of cards. The brightness of the points is proportional to the probability of holding those cards. In contrast to chess, poker is a game of partially observable information. Now let's look at the game dynamics. In chess, at each turn, players have to pick one of the pieces and choose between the legal moves available to that piece. When a player makes a move, a new position appears on the board. The transition between positions during the game is completely deterministic, meaning that there is no doubt which board position will appear after a certain move has been made. We can visualize the dynamics of the game by introducing parallel planes arranged on the time axis. We see the transitions as the time goes on. After each move, there is a unique path from one position to the new one on the subsequent plane. A strategy is a collection of decisions from beginning to the end. More precisely, it is a function that takes a game position as input and returns actions as output. To give an example, the most trivial strategy is to choose random moves at each turn. It is a bad strategy for the game of chess, as it is completely detached from the objective goal of the game. If we can assign a probability of winning to each position in chess, The purpose of making a move is to increase, or at least not decrease, that number. Since all the information and transitions between positions are known, it is possible to explore all potential future scenarios, calculate the likelihood of success for each one, and then select the best moves based on those probabilities. Recognizing patterns in different positions and accurately calculating potential moves are some of the most important skills that every strong chess player develops over time. For poker, the situation is completely different. The decision is between checking, raising, or folding at each turn. The difference is that after each decision, there will be community cards revealed from a randomly shuffled deck, which will change the state of the game. Unlike chess, this transition is probabilistic. Different combinations of community cards lead to totally different states. Let's revisit the state planes once more. The state transitions are now represented by dashed lines. Each transition is equally likely and shifts the game along a different path, depending on the cards dealt from the deck. There is always the risk that the board could shift in our opponent's favor. Unlike chess, we can't be certain that every optimal decision we make will improve our chance of winning. So to build optimal strategies in this game, we need to get skilled at making decisions under uncertainty and not being predictable to our opponents. This often leads to the use of mixed strategies. These are strategies that generate a range of possible actions, each with an associated probability. A simple example of this is the game of rock, paper, and scissors. To avoid being exploited by your opponent, you need to randomize your choices at each turn, ensuring no predictable pattern emerges. We also need to fundamentally understand how the randomness of the cards introduces risk and volatility into the game of poker. No matter how strong our decisions are, there's always a chance we could lose a hand. Winning at poker is a long-term effort, which does not only rely on how optimal our strategies and decisions are, but also how we can manage risk and emotions. Now let's see how these concepts can help us understand the fundamentals of investing and trading better. We start with investing. People usually decide on investment opportunities based on various pieces of information. On the company level, they usually look at diverse financial statements, fundamental analysis reports, valuation of the company, and so on. They also might look at the market as a whole to gain information about the perception of other market participants. Things like market heat maps provide these kind of data. It might also be useful to look at the economy at large scale, things like interest rates, GDP growth, and inflation, to gain information about the overall sentiment of the market. But trading seems to be a different game. Traders use other sorts of information. Things like price movements, volatility charts, and technical analysis are more relevant than the income statement of a company, for example. The parameter that shifts the scale from one side to the other is the time horizon, in which you aim to realize your potential financial gains. In chess or poker, the time scales are predefined. You have to play a chess game until there is an end result. In poker, there are certain betting rounds, and the hand will eventually terminate after the last round of betting is completed. In finance, however, you can set the timescales individually. You might want only to build a long-term portfolio for the retirement, or you may want to generate consistent monthly income from the markets. These scenarios demand entirely different decision-making approaches. Not only does the frequency of decision-making vary in these cases, but the type of data and analysis required are different. In reality, all of the data points we mentioned so far are observations made from a single unified environment. Assume that the true hidden state of the economy and all its entities, things like companies, employees, financial markets, traders, investors, and so on, is a gigantic multidimensional sphere. This sphere represents the complete interconnected reality of the economic world, with every possible variable and relationship encoded in it. Now think of every piece of data we have discussed so far as observations that reveal glimpses of this sphere. These observations are like shadows cast by the sphere onto the surfaces of different orientations and dimensions. Naturally, you lose information when you project a higher dimensional object into a lower dimensional surface, like shadows, which are two-dimensional projection of 3D objects. What we see is only a partial, simplified representation of the object through its shadows. In this simplified model, a long-term investment can be compared to a flat surface with proper angles, where shadows confidently represent the true object. For example, a tech company specializing in AI, with strong profit margins and consistent year-over-year growth, represents a promising investment opportunity in today's market. Why is that? Well, historical data shows that over the long term, companies in similar sectors and with comparable profiles have a high likelihood of appreciating in value. This is similar to chess, where following certain patterns on the board generate an advantageous position for the player. In fact, the longer the time horizon, the more this investment game resembles chess, where observations provide more complete information about the true state of the game. Shorter-term observations are less reliable, like a sphere casting a shadow on a distorted, tilted surface. On top of that, imagine an extra layer of noise that obscures the shadow, which makes it even harder to discern as the time frame gets shorter. Trading in these time frames requires the ability to deal with noise and making decisions under uncertainty, much like playing a game of poker. For example, consider a day trader analyzing a biotech company stock, waiting for a new drug approval. The stock might swing dramatically based on rumors, news headlines, or market sentiment, even though the underlying fundamentals remain unchanged. In this scenario, the trader must navigate a flood of noisy data and develop precise entry and exit rules to give him a higher chance of profit, while managing the risk of losing money in the trade. Success in this environment depends on integrating volatility, managing risk, and staying disciplined to follow the trade plan. Let's summarize the key takeaways from this video. Your approach to investing depends heavily on the time frame. For long-term investing, you need to be able to analyze the data points to find reliable long-term patterns that will generate profit. After building the initial portfolio, you might not need to make many decisions. Typically, you rebalance the portfolio based on some predefined criteria along the way. The risks, however, are often underestimated. Passive investors sometimes assume long-term holdings are safe by default, or they would not properly calculate the risk. Black swan events, inflation, and systematic market risks can still derail even the most stable portfolios. On the other end of the spectrum, short-term trading mostly resembles poker. It's dynamic, with frequent decisions and higher uncertainty. Here your edge comes from strategies with positive expected return, calculated bets, where potential rewards justify the risks. However, this requires rigorous risk management. Volatility isn't inherently bad, it can create opportunities. Some strategies, like those used in poker, intentionally embrace higher volatility for greater upside. But without discipline, this becomes gambling. Remember, no strategy is foolproof. The market will always present unexpected challenges. Your job is to build a framework that accounts for all of uncertainties, adapts to new information, and keeps emotions in check. If you found this helpful, leave a comment below. Which challenges resonate most with you? Managing long-term risks or executing short-term strategies? Share your thoughts or questions. Don't forget to subscribe for more deep dives and hit the bell to stay updated. Thanks for watching.